Welcome to Real Estate Economics webinar series. Real Estate Economics is a leading provider of residential market consulting services and online research tools. On a regular basis, we present a variety of topics relating to the residential home building and land development industries. I'm John Mulville, Vice President of Consulting here at Real Estate Economics, and I'll be presenting today's webinar on California economic and employment market forecasts. We'll cover the statewide employment, look at some local employment areas, and see how that factors in to housing demand across the state. Let's begin by looking at the total state employment non-farm payrolls going back to 1990. This really sets the stage for California's current condition. As you can see, California had some very robust employment numbers as recently as 2007, when we peaked at about 14,600,000 jobs. That's a high that exists to this day. In the time frame from 2007 to 2010, the state has lost about 1.34 million jobs, which really drives our housing market problem that we're having today. If you look back at our current total for 2010 of about 2010-2011 of about 13,300,000 jobs, that's roughly equal to the 1998 and 1999 employment totals for the state. If you look out in our forecast period to the last year shown at 14,421,000, that is still below the employment that we last achieved in 2007. So we're facing a little bit of a drawn-out recovery, and we really have a situation in the state where we have not produced the types of jobs needed to support the population and the housing economy, not for 1 year or not for 2 years, but for a decade or longer. This particular graph shows 12-month and change in employment going back to 1990. As you can see, there's a time period from 1994 to about 1999 where California gained quite a few jobs after the military defense industry was restructured in the early 90s. We had balanced budgets, almost balanced budgets nationally, and the employment environment was much better then. As we got into 2001, 2002, 2003, we lost quite a bit of employment due to the dot-com bubble. We had a big run-up in employment leading to that. You can see those numbers in 99 and 2000, but the payback came in 2002 and 2003. Then we had another brief upcycle in 2004, 5, and 6, and 7 as construction, much of it residential, caused by housing demand from subprime mortgages, led to another boom in construction. But now, in the 2008, 9, and 10 time period, we've paid all that back. As you can see in our forecast period, we've got some fairly decent employment gains coming in the next 5 years, but as I mentioned, we won't surpass 2007 totals during the forecast period. In a sense, California has gone through a boom and bust cycle. It's a bust with defense spending, a boom with the dot-com, a bust after the dot-com, a boost with subprime, and now the recent recession and financial crisis leads us into another bust period. So California has a very well-defined characteristic of excesses through time. Let's look at the state unemployment. These are annual figures, so the actual employment today or tomorrow, I think the figures come out this Friday, March 4th, may be slightly different, but all our numbers are annualized here. One of the things that we should note here is that California's unemployment has been much slower to recover than most other parts of the nation. In fact, the highly impacted states like Michigan, South Carolina, Rhode Island, some of the states with very bad employment and business environments have begun to show recovery. California, at least up to the last few months, is still degrading. Now, we're expecting that to turn around, but it's been a protracted decline for us, much longer than it's been experienced in most of the nation. Here is California employment by industry group. You can see where we're strong, in some cases strong, in some cases heavy. Government has a big presence. Leisure and hospitality. Everyone knows people like to vacation in California, and that's even more pronounced when there's terrorism and incidents across the country or across the world where people are more likely to stay in the States. And if they do stay in the States, California is a preferred destination. California is a leader in many ways in education and health services, hospitals, research, biotech, one of our very, very strong areas, business services, transportation. Manufacturing is held up in some areas of California fairly well. And believe it or not, we have a relatively significant resources and mining sector, including recently discovered rare earth metals. Here's California state change by industry group. So we're looking at the same industry groups only on a 12-month year-over-year change. As you can see, we've lost tremendous numbers in government. Now many people say, well, wait a second, I haven't seen anybody in government getting laid off. Really, there's been hiring freezes across the state, covering many cities, many police departments, many different boards and smaller sectors other than just the larger state government, where positions are going unfilled. And as people gradually retire and move out of the workforce, those jobs are not being refilled, and those employment totals are coming down. Again, we're growing. Leisure and hospitality looks good. Education and health services growing. Financial activities is off a little, although we are picking up people in REO servicing, asset management, those sorts of fields. Information. Everybody recognizes there's a big wireless boom, iPads, 4G, data transmission services, all that sort of thing. That's a big area for California and has made very strong employment conditions in parts of Northern California in particular. We are still losing construction, and even though we're showing minus 4,000 in manufacturing, that's actually reflects a steadying in construction, in manufacturing, I should say, across the state. Let's look at a slightly more localized area here. This is Orange County, California, one of the areas that's performing relatively well. We have a few markets, including areas of Northern California, particularly the South Bay, East Bay, high-tech areas, San Diego with its biotech, and some of the coastal counties seem to be performing quite a bit better than some of the inland counties. And this is one of the reasons why we constantly counsel our clients to look at the employment. We have an employment report you can run off our website. It gives you many of these charts and tables that you can look at the employment in your particular area and decide if that's a place to build. There's housing models that are based on demand. There's some that are based on households. There's some that are based on population. But we would maintain nobody's buying a house without a job, so employment becomes a very, very important part of it. Here's the national change. Since we looked at the state and some local areas, I thought I would include national. Here's the national change year over year, and you can see some of the similar trends that are occurring. Government is losing. Government may be on the initial cusp of far bigger losses. That's really hard to tell. Leisure and hospitality, you can see California has a disproportionate share of that leisure and hospitality. Education, financial activities, a lot of those jobs are being lost, not in California, but in New York, Boston, Chicago to some extent. Information's not doing nearly as well. It's losing nationally, but gaining in California. So you can see the importance of Facebook, Google, HP, and all the smaller companies that do wireless transmission and data software, that sort of thing. Manufacturing, holding up, at least showing good numbers here. Construction still nationally down quite a bit. Resources, natural resources and mining still have an important part in our modern economy. California is showing its initial signs of employment gains, and we've covered this in a couple other tables, but you can sort of see the magnitude of the oscillations here. The periods of growth in the mid-90s tail off into the dot-com in 2001 and 2, subprime boom in 04, 05, 06, and then really the huge losses on a 12-month period in 2008, 2009, and we're starting to pick that up and recover here. You can see the circle on the right-hand side. We've got some increases coming in through the course of 2011 into 2012 and beyond. There's a little bit of evidence that some of those new jobs are coming in the preponderantly in the lower wage levels. It's almost as if maybe half of the jobs are in the lower wage levels, another 30% are in the medium, and fewer are in the high levels now. Part of that may be that people are making somewhat less money as they accept whatever position they can in today's economy. Now, how this plays into housing construction, I mentioned just a moment ago. You could do a demand model based on population, based on household formation. But what this is all playing out to is look at the low levels of construction across the entire state in the latest years, 2010, 2011, 2012. There were several years in the early and mid-2000s where San Bernardino and Riverside alone did 35 or 40,000 permits. Now we're getting that for the entire state on an annual basis. The state has continued to gain 200, 250,000 new residents a year. So unless those people are living 6 and 7 and 8 per household, we are underproducing houses at this time, and we'll gradually begin to absorb our slack and our vacant units that are coming out of foreclosures, short sales, deeds in lieu, that sort of thing. You can see that in this particular graph. Here we show new home construction in the light blue and shadow inventory, which we're characterizing as homes that are owned by lenders that still are not yet out onto the market. And as new home construction pulled back in 07, 08, 09, right through 2010, we've had an acceleration in the distress supply, and that's gradually working its way through the system. Various things you've heard of robo-signing and the different delays, moratoriums that have kept the lenders from really pushing this inventory out how we think they would probably want to. But gradually it's coming out. We're seeing a certain tendency for the lenders to quickly sell or short sell any unusual property. If it's highly priced or any sort of oddball location, oddball setting, they'll put that home out and short sell it and take the best offer they can get. But when those homes are in good, steady neighborhoods where the values are clearly established, many of the lenders have chosen to hold on to those and sell those themselves where the values are well known. We've all heard that many, many sales are cash transactions. We believe that rental investors are active in this market, buying some of the best rental opportunities, going through the local foreclosures, making all cash offers on those, and immediately putting those into the rental stock. Now you have to expect that most of the people doing that are seeking appreciation over a defined ownership period. So 3 or 4 or 5 or 6 years out, when that house is appreciated back up, that home is likely to come back into the market. So until we have a job base that's at least as big as the former peak, a lot of those homes are just going to be sort of in the bullpen, waiting to come out when prices rise high enough. That puts a little bit of overhead resistance into the market and puts somewhat of a lid on prices over time. Let's look at 30-year mortgage interest rates. This has been an area of tremendous interest. We've been in a roughly 30-year super cycle of declining interest rates going all the way back to the 80s, really 10 years before the beginning of this chart. And with some oscillations up and down, rates come down quite steady through the Federal Reserve intervention in the mortgage markets in I guess that would have been 09, when we went from about 6% to 5% and then trended lower. Those rates are starting to trend up. There are probably some ancillary issues that are going to make mortgage costs increase more than just the rates shown here. There are various proposals out there to include fees, depending on your credit, to include fees from the originators for different things. There are proposals for the Federal Reserve to make a qualifying mortgage standard where lenders would not have to hold reserves against a mortgage, and they're talking about that including very high credit scores, 20% down payments, and just a laundry list of other things. Those ideas are still being formulated, but it looks like a qualifying mortgage, as it's being defined, is going to be a high quality mortgage, getting the lowest price, obviously, but having high underwriting standards. And we think that non-qualifying, or it won't be subprime, but sub-qualifying mortgage standards are probably going to be much more expensive and really have a sliding scale of rates depending on your credit quality.